Do you think a lot of companies out there have both cyclical and defensive tendencies?
But if you put all your money into one investment, you lose everything. This is a company that has had a very bad year.
How's it going, everyone? Welcome back to another episode of the Investment Hound podcast. Before we get started on our two very interesting shares today, if you haven't already gotten yourself a copy of Grandad's book, Successful Investing, How to Make Money in the Stock Market from Real Life Experience, make sure you go and get yourself a copy today. The links can be found down in the description below. And the second thing is make sure you follow us on Instagram and TikTok at The Investment Hound. And also, if you have any questions for Grandad, shoot us an email on paddy@theinvestmenthound.com. So for those that have been keeping up to date with our podcast series, you will know that we are building a portfolio of shares using all the information from Grandad's book and also all the information that Grandad's taught us at the beginning of this podcast series. So we'll just quickly run over the shares that we have. We have 16 shares at the minute that we have looked at. So we'll quickly run over what they are. The first
I'm on that podcast.
The first is Whitehaven Coal Limited, the mining company. We have CVS Health Corporation. We have Volkswagen, Adecco, Banco Santander, Total Energies, Sunoco LP, which are energy fuel distribution, Ryanair, National Australia Bank, Bristol Myers Squibb, EDP Energias, Verizon, Woodside Energy Group Limited, Emira Incorporated, and then the two we did last week were Alphabet Incorporated, which is Google's parent company, and MasterCard, who of course are the payment processing company.
Can I also say at this point to you, Adam, that if you look at the book, oh God almighty.
The most popular man in South County Dublin.
At this point, it's probably worth pointing out that in the book, I build a portfolio. And it's done. Pat, I'll ring you back. I thought I'd switched it off. I must have switched it on. In the book, I do point out that I do build a portfolio of shares. And you'll see that if you read the book, that there's no rhyme nor reason to them. It's just shares that are, I'll buy this share, or I'll buy that share, and for this reason and that reason and the other reasons. And in many cases, I had sort of good reasons, but there were kind of, one-dimensional reasons. I didn't have 12 reasons to buy a share. I had one reason to buy a share. And similarly, as we build now, we're doing exactly the same thing. So, for example, Adam has chosen roughly half the shares on his basis. And I've chosen half of the shares I currently have. Okay. So effectively, you'll see that it's at this stage, it doesn't make a lot of kind of coherent sense to what we're doing. And that's what happens when you build a portfolio, because you're changing your mind about what you're going to do and so on as you go along. And so at some stage in the future, we'll start to rationalize the portfolio and manage the portfolio, but we have to build it first. So that's where we are.
Super. Okay, well, let's dive into the first share that we'll be looking at within this podcast episode. Are you going to say something?
No.
Okay. The first share we're going to be looking at is Legal and General Group PLC, founded in 1836. They're a UK-based financial services company specializing in insurance, investment management, pensions, and retirement solutions. And they're one of Europe's largest asset managers, and they focus on sustainability and operate in the UK, US, Europe, and Asia. So the primary listing is on the London Stock Exchange. Their sector is life insurance, and the sector type, now maybe you can tune in here, Grandad, but from my research, they're both cyclical and have defensive tendencies as well. So the research here tells me that Legal and General exhibits cyclical tendencies due to its reliance on financial markets, economic conditions, and interest rates. But it also has defensive qualities such as insurance and retirement products that are essential services that maintain demand during downturns.
You have to insure your house, no matter what the actual what the economic situation is, or if you're locked into a pension fund that's taking money out of your salary, that's going to come in. However, in bad times, fewer people will have salaries, and people won't have as much spare cash. So volume of business will go up and down a little bit, but in certain discretionary areas in their business, as well as the impacts of if you like, financial conditions on their performance.
Do you think a lot of companies out there have both cyclical and defensive tendencies?
Oh, yes, they do. I mean, if you take, for example, Marks and Spencer's. Marks and Spencer's have a big food arm. Well, I mean, you have to feed yourself no matter what the weather is like, no matter what the economic weather is like. But on the other hand, they also do clothes. Well, you're not going to be buying, the new dress or the new suit when times are tight or when you're worried about your future. You're going to buy them when you're much more comfortable. So there's an element within Marks and Spencer's of consumer discretionary, and there's an element of having to buy food and things like that as well.
Yeah, it's like a good managerial strategic decision to probably engage in both cyclical and defensive operations.
Well, yeah, because the larger the business, the more likely it is diversified. So in other words, it'll be in more than one business area. If you were a small business, the chances are, that let's say you're a small insurance broker, chances are you have 3 or 4 insurance products full stop. But if you're a big, large wealth manager, you might have a stock exchange arm. You might have, all sorts of things. You might expand overseas, all this kind of stuff, right? But you need scale to be able to do things like that. So the smaller companies are very focused in on small thing, on specific things. The larger companies diversify like hell, because that's how, like with investment in our case. I mean, why do we not put all our money into one investment? But if you put all your money into one investment, you lose everything. So therefore, that's why I tend to put about 5,000 into each investment. And as I said to you earlier in the podcast, I can't understand guys coming up to me and saying to me, fellas like me now that are not very wealthy, right? Saying, I just put 20,000 into such and such a share. I say, why didn't you buy 4 shares for that? 5,000, and give yourself a bit of diversification. And that's what the businesses do as well.
Okay, well, moving on then, we have the market cap of Legal and General is 13.5 billion. The current prices of today was 221.4 GBX, which is the equivalent to £2.21.5. The dividend yield as of today is 8.96%. And then a little note I have here is that in 2023, Legal and General Group PLC reported a dividend of 0.2 Great British pounds, which represents a 5.01% increase over the last year. And the 14 analysts covering the company expect the dividends of 0.21 Great British pounds for the upcoming fiscal year, which is an increase of 4.72%. Now we move into the difficult figures, which is what actually makes this share very difficult to analyze for someone like me, a complete beginner. We have the dividend payout ratio, 4,573.08%. So year on year, the growth in dividends per share increased 5.01%, while the earnings per share, excluding extraordinary items, fell by 85.07%. So the positive trend in dividend payment is noteworthy, since only some companies in the investment services industry pay a dividend. So that's definitely a noteworthy financial.
Well, you see, what it says is this is a company that has had a very bad year.
Yeah.
And the question really is, if you have a company that has a very bad year, let's take apartments. Okay. And let's say you have an apartment and it has cost you, say, 350,000. And let's say it's now valued at 250,000. The question is that a bargain for the guy who is willing to pay 250,000 for it? Or does he feel, my God, that's going to go down to 150,000? So, a bargain is when you are, when your share price is cheap. And your share price is cheap because something went wrong. Your share price isn't cheap because something went right. Because if something went right, your share price would be up there with the best. Okay. So the question you have is that a bargain or is that a mistake to invest in it? And that is the question you have to ask.
Well, moving on then, okay, we have the PE ratio, which is quite confusing for me, a beginner investor as well. which is 549.16 times.
Yeah, and that's because it made peanuts of profit. So the price is the PE ratio is the time that the earnings divide into the profit. So if you had a profit of 100 or a price of 100 and earnings of 10, the PE ratio is 10.
Yeah.
But if you had a price of 100 and the earnings is a half, what's that working out at?
If you have a price at 10 and the earnings is a half, you said?
No, if you have a price of 100,
Price of 100.
and the earnings is a half.
Yeah.
Well, by definition, isn't that 200?
Oh, yeah, okay. Yeah.
200, isn't it?
Yeah,
Right?
yeah,
So if you have poor earnings, you have a high PE ratio if the market decides to assume that the earnings will recover.
Yeah.
So to some extent, it's frightening to see 549 of a PE.
Yeah.
On the other hand, if you believe that it's a bargain, it's comforting to see that PE ratio is not infinity. You know, it's not crazy. It's 549 times, which you'd expect. And if next year the earnings normalize, then it'll go back to that's good news.
Yeah. Okay, well, let's try gather.
And can I also say to you, and another thing that you have to take into account is you said that the dividend yield, or the dividend is expected to grow by
4.72%.
Well, if the analysts thought that this was a dog and was going to collapse further and further and further, they wouldn't be predicting an increase in the dividend next year, would they?
That's a good point.
Right. So you have to take all those things in their totality to reach your conclusion. I'm strongly of the view that this is a share that will bounce back, and that this is a share. It's a good investment. Because one of the things that happens with insurance companies is they have a lot of money invested in bonds. And bonds have bonds are loans, mainly loans to the governments, right? Government bonds like exchequer stock or treasury stock or whatever you have to call it, right? So they put a lot of money into their money into those kinds of stocks, okay? Now, they're nearly all fixed rate stocks. So if I invest in a 5% stock that's fixed by the government for the next 10 years at 5%, okay, and interest rates rise to 10%, I'm still locked in at 5%. Do you agree with that?
Yep.
So if I now want to sell that stock, what would I have it to sell it to you at? What
5%.
would you be expecting? No, what would you be expecting?
Oh, well, I would be expecting 10, but you can only sell it for 5.
So no,
Okay.
that's not. The coupon is fixed at 5, right?
Okay.
But if I sell it at 50, that 5 represents 10%, doesn't it? Like
You're confusing me here.
The amount that the government are going to pay you in interest each year is fixed at 5%. So if I buy a stock for 100, okay, that stock is going to generate 5 of interest each year, correct?
Okay.
Do you agree with that?
Yeah.
Because it's fixed.
Yeah.
Okay. 5 at 10%, 5 every year for 10 years.
Yeah.
Now, if the interest rate, the prevailing interest rates change from 5 to 10%, okay, and I want to sell you that stock, I can only sell you a stock that's going to generate 5%, but you can get 10% anywhere else in the market. So therefore, you'll only buy it from me if I can guarantee you 10%. So that means instead of me selling it to you for the 100, which is the nominal value of the stock, I sell it to you for 50.
Okay.
So you pay 50 for a stock that's going to give you a dividend of 5. What interest rate is that? 5 and 50. What's 5 as a percentage of 50?
Sorry, it was cutting out there on my screen.
What's 5 as a percentage of 50? What interest rate is 5 on? If you pay 50 and you're going to get 5 for the every year, what 10%. Interest rate is 10? So therefore, in order for me to encourage you to buy the stock, when interest rates go from 5 to 10%. I have to have the value of the stock. I have to sell it to you for 50 rather than 100. Does that make sense to you?
Okay, yeah, that makes sense.
Okay. So therefore, if I sell it to you for 50, okay, I've lost 50 on the stock. But I've got rid of the stock. I've got the cash, but you're now on 10% per annum. Does that make sense to you?
Okay.
Does that make sense to you?
Yeah, so it's better for me then.
Yeah, the only way I can sell a stock if interest rates go up is to drop the price.
Okay.
And the only way and on the converse is true. If interest rates fall and you're only looking for 2.5%, I can sell you the stock at 200. Does that make sense to you?
Yeah.
Because it's a fixed interest rate, okay? So when Legal and General are doing their balance sheet, they put in the value of the investments at the current market price. Now, we all know interest rates have risen dramatically, okay? Which means all those bonds they have are underwater. If they sell them, they have to sell them at less than what they paid for them.
So that would explain the poor financials then.
So therefore, they have to take a hit to their P&L. However, if those bonds recover in price, in other words, if the interest rates, which are currently in the UK, are 4.5%, if the interest rates came down to what they were when I bought the bonds, let's say 2.5%, that negative is reversed. Okay? Does that make sense to you?
Yeah.
So I would maintain that that's a stock worth buying because it's temporarily depressed. And the analysts, well, let's go on and see. What did the analysts say about the future of the stock?
So the analysts were predicting, bearing in mind the current price is 221.4 GBX. The 13 analysts offering a 12-month price target for Legal and General have a median target of 256 GBX with a high estimate of 335 and a low estimate of 220. Bearing in mind the current price is 221.
Yeah. Now let me ask you another question. How many of them are saying sell? How many of them are saying hold? And how many of them are saying
The
buy?
majority, I can get you the exact numbers, but the majority were rating it an outperform. Good man.
60% of the analysts are saying that the share will outperform. 60%. Okay? And a very small percent are saying that the share will dip down. So if you believe the analysts and you believe what they're saying about the dividend going forward, you must believe that that share price is going to recover. Okay? That makes it a bargain rather than a dog. Now, you might reach a different conclusion, but to me, I think it's a good buy. Now, by the way, I bought it at more than €2.20. Okay? So my fingers are crossed, but I'm staying in. I would not sell a share that's fallen if I'm getting a 9% or what is it? 9%, roughly a 9% dividend yield. Okay. I'm saying, well, you know, what will I do with the money? I'd take a loss, and then I'd be looking for 9% somewhere else. So I'd stay in it. And the analysts seem to be saying it's going to recover.
It makes sense to me when you explain it on the podcast, Grandad, right? But my conclusion from it was that when I was going through all that and when I was reading the news, that's kind of, do you know what? It's, when you explain it, it breaks down and it's basic understanding of economic interest rates and bonds. But when I was reviewing it, I couldn't make heads or tails of it, to be honest.
Yeah.
So my conclusion as a beginner investor would be, go back to the basics. I don't understand it. Don't invest in it.
And
but as you explain it, it makes sense.
Well, on the other hand, you may still think like that. Do you know what I'm saying to you? I can only tell you that's my view. Is it's a strong buy.
Yeah.
Okay. But you've seen me making mistakes, and that could be a mistake. But I think it's a strong buy.
Well, your argument is backed up by the analysts there as well.
That's right. That's right.
So it's an interesting one.
Yes, it is, isn't it?
It is. So what would be your time frame on it then?
Well, the RSI, do you know what the RSI on it is?
I don't know the figures.
58.
Okay.
Now, what they say is that if it hits 70, the share price will fall. And they say if it hits 30, the share price will rise. So my view is that once it's down around 45 or lower, it's a buy. But once it's above 50 or higher, I'd wait. So I would wait until the RSI comes down below the 50, down to 45 or something like that, right? Before I'd buy. But buy I would then.
That's actually an indicator in the back of the book.
Yes, it is.
And I actually haven't been looking at that indicator when I've been analysing these shares. So that's going to be something I'll be looking at in the future.
Well, you see, when we come to look at the portfolio when it's built, I'll be showing you all these different indicators that I use, and I'll be saying to you, take those and change those indicators where you think you should change them, drop them where you should drop them, add extra ones where you think you should add them, and then review the shares. Do you follow me?
Yeah.
So that's the next. That's phase 2. We're building at the moment. And we're building blindly at the moment, if you know what I'm saying to you. Because there's always a risk when you're investing in a share. Nobody knows what's going to happen to it.
Well, can I ask you a question, Grandad? Right, so the Legal and General are listed in the London Stock Exchange, okay, and they're directly impacted by the interest rates set out by the London Central Bank or whatever it's called, okay?
Yeah.
There must be other ones. The Bank of England.
That's the Bank of England.
There must be
and of course, you know that I
companies.
worked in the Bank of Ireland.
Yes. There must be other insurance companies then that are in the same position.
Yes, there are.
So in theory, the insurance sector should be down.
Yeah.
Or the life insurance sector should be down.
Yeah, yeah. Anyone who has loads of bonds is down when interest rates go up. You know, but the thing about interest rates is they go up and they go down. And they go back up again and they go down again.
And because Great Britain is kind of experiencing a lot of exile, aren't they, at the minute?
Exile.
A lot of the shares are moving over to the New York Stock
Oh,
Exchange.
yes, that's correct. That's correct.
It would encourage the Central Bank of England to lower the interest rates, wouldn't it? To encourage borrowing.
First of all, what does the Bank of England, which is a central bank, okay? What drives central bank policy? Well, in Europe, exclusively what they're supposed to manage is inflation. Okay? And they are comfortable with inflation of around 2%. If they were to target inflation of 0% as their target, if inflation goes minus, everyone says, oh, good God, I'm going to buy an apartment today. I'd wait till next year because it's cheaper because inflation is minus. Okay? So once inflation goes to minus, people stop spending. And if people stop spending, the economy goes into absolute whirl downwards. Okay?
Has it happened before?
Oh, yeah. So they can't afford. We had negative inflation 3 times, I think, between 2010 and 2020. Very, 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 but only in those 3 years. Okay.
Wow.
But inflation outside of those 3 years was under 1%. And the central bank had moved interest rates down to the floor to
so that might go up there.
So it would go up, but it took 10 years for it to go up, right? So they're scared of it going down to below 2%. So they tend to target 2%. They're not down at their beloved 2% yet. Now, in the US, it's slightly different because in the US, they have the US Fed have been given contradictory obligations. One is to keep inflation down at the 2%, and the other is to make sure that unemployment doesn't rise. Okay? Now, of course, if they raise interest rates, unemployment does rise. So at times they have to jump from one horse to the other in the US, whereas in Europe and in Britain, they actually only have one horse to ride, and that's the inflation horse. And the trouble they have at the moment is they can't get the inflation down to the 2%. Because when inflation is high, the people that suffer are the people who can't afford it. The rich guys can afford to live in any environment, whether it's, high interest rates or low interest rates. But the further down the chain you go in terms of your earnings, the harder it is to survive when interest rates go up. And also, the other thing is that when interest rates go up, it dampens down investment. So businesses are not investing in their business to expand for the future, which is economic growth, which helps the economy. So, what the Bank of England is now doing is keeping interest rates up at 4.5% until inflation comes down to 2%. And they're not sure when the Bank of England will start to drop interest rates, but they reckon there'll be some drop within the next 12 months. And they have to go from 4.5 down at least 2%. And when that happens, Legal and General is going to make money.
2% seems like a massive jump.
Well, but you see, if inflation is 2, okay, then the government probably borrows at 2.25 to 2.5 over 10 years. Remember, inflation is today. This is a 10-year commitment. And you're not going to go in at 2 because if next, that's just barely keeping your money static. You want some benefit to come from your investment. So 2.5% would be kind of acceptable. 2 is not acceptable over 10 years. You're not going to lock away your money for 10 years at 2.
So would you say then, Grandad, that you're just going back to the time frame? Would you say then that your time frame for this would be maybe 2 to 3 years?
Oh yeah, well, I'm a long-term investor, and I would have thought that next year, if they took the hit this year to get the bond pricing to equate to 4.5% bond yields, okay, even if next year there's no change in bond yields, they don't have to take that hit again next year. They've taken it this year, so there'll be certainly an improvement in the profits of Legal and General, and within 2 years, I suspect they'll be getting some of that loss that they have back again as the interest rates start to fall. And look at the European stocks. We've had 0.75% drops in it, or 0.75% drops in the last year. So that's going to happen in the UK at some stage in the future. And Legal and General will do well out of it, in my view. Will I get it right all the time? I won't. But I'd be willing to bet my money on it, is what I'm saying to you. There's nothing certain in this life.
Yeah.
But once you're investing in equities, you're taking a gamble. There's no such thing as a surefire winner.
Yeah. It's a really
other than Donald Trump is going to totally transform the American economy for good. That's what the Americans believe. I don't believe there's anything. I don't believe in the silver wand. That one man has a silver wand and will wave that silver wand, and all our problems will go away, and we'll all be much better off. But I'm willing to bet on Legal and General and take my chances.
What are some potential threats you might see about investing in Legal and General?
Well, first of all, interest rates is the main one there. Okay,
as in interest rates not going down.
Yeah. And the Bank of England is an outlier. The ECB have dropped their interest rates. Now, the US Fed dropped their interest rates as well, but they thought they were going to drop them every quarter. They thought there was going to be 4 interest rate drops this coming year. They're now saying at best 2 interest rate drops this coming year, because inflation is sticky. And when you have Joe Biden going in as president, and he brought in 2 acts, which is costing trillions of dollars to finance, that's keeping interest rates up. And then when Trump gets in and gives away all his tax cuts and so on and so forth, that will also keep inflation up. And the US Fed will be loath to drop interest rates in the US. So, but in Europe, inflation is down at 2.2%. So it's virtually where they need it to be. And it looks as if they'll get down to where they want to be interest rate wise this year. They're at 3 at the moment. They'll probably come down at least 0.5%. And
Good.
when you talked about legal and general there, you talked about operating in all these other countries, in all these countries. So it's affected by the bonds in all these countries. So, if Europe comes down, that helps legal and general. If America comes down, that helps legal and general. If Britain doesn't come down, it doesn't help legal and general. On the other hand, Britain might come down, and US might stick. We don't know.
I understand it more now. However, if I were to invest in it, it would be a very small portion of my portfolio because it is still a little bit confusing.
Well, you see, the issue is very simply this, right? It's in the doghouse. And you have to decide, is it in the doghouse because it's a dog, or is it in the doghouse because it's a lovely, lovely penguin waiting to walk out up to the stars? That's it.
See, the phrase that we always use, Grandad, that probably goes through my head at least 5 times a day: when there's blood in the streets, you buy.
That's right. There's blood in legal and general at the moment.
But that theory is like, it's very easy to say that. But when you actually have your money sitting there in the account and you're looking at a share that has blood in the streets, it's actually nearly a little bit hard to commit to it.
Well, I had coffee with a few lads this morning. All worked in the bank with me. And none of them invest in shares because they lost their shirt on Bank of Ireland shares in the 2008 to 2010 period. They're still bleeding from it. Your generation weren't alive then to what was going on in the markets.
Yep.
So you guys are more likely to be, in their eyes, more foolish and invest in shares than my generation are.
Yep.
But there's a lot of money to be made in shares.
In contrast to that, though, there is a huge amount of information available to us online now.
Yes, there is.
About the safer ways to do it.
What do you mean?
Index funds, investing in geographical regions rather than, like you said, a lot of the guys that you knew thought they were diversifying because they were investing in Anglo-Irish Bank, Bank of Ireland, and so on, all in the Irish market, in the one sector.
Yeah.
But nowadays, there's so many different products out there that we can invest in. The S&P 500, we invest in 498 different shares of the largest market cap shares equally, or not equally, but equally in terms of their weight in the US and in other economies as well.
Do you know the most interesting thing you have said so far on this podcast, which was music to my ears?
What?
Well, yes, an interesting share, but if I invest in it, I'll invest very little.
Yeah.
That's what I like to hear. Spread your investments around.
Yeah. Okay, well, we've kind of run over time on this share, Grandad, okay? But this was definitely very, very, very interesting.
Well, now the other one is
Let's do the
also
other one.
an interesting one.
Yeah. Okay, so our second share is a company called BASF SE. Founded in 1865 and based in Germany, they are a leading global chemical company, and they produce chemicals, materials, and agricultural solutions focusing on innovation and sustainability. Operating in over 90 different countries, they have a strong global presence. So their primary listing is on the Extra Stock Exchange. Is it, Grandad? Is that correct? XETRA?
Well, it's really the DAX, the Frankfurt Exchange.
Okay. Their sector is in chemicals, and their sector type is cyclical. The market cap is €37.07 billion, and the current price as of today is €41.96. Their dividend yield is music to Grandad's ears. It's 8.01%, and in 2013, BASF SE reported a dividend of €3.40, equaling last year's dividend. The 24 analysts covering the company expect the dividends of €2.49 for the upcoming fiscal year, a decrease, not music to Grandad's ears, of 26.88%. The payout ratio, similar to the last one, well, not similar to the last one, but similar in range, is 602.41%. And year on year, the growth in dividends per share remained flat, while earnings per share, excluding extraordinary items, increased to 136.25%. Additionally, when measured on a 5-year annualized basis, dividend per share growth is in line with industry average relative to its peers. One thing I forgot to mention about the dividend yield is that I actually found a bit of interesting news in the dividend yield. So in response to market challenges, BASF has announced plans to reduce its annual dividend and implement cost-cutting measures, including potential divestments of non-core assets to maintain financial flexibility and focus on strategic growth areas. So moving on then to the PE ratio, we have a PE ratio that's pretty high of 74.43 times. We also have a beta of 1.21 times. And then some information on their income statements. So year on year, BASF SE had revenues fall 21.1% from 87.3 billion to 68.9 billion. The company grew net income from a loss of 627 million to a gain of 225 million. And in relation to the cash flow in 2023, BASF SE did not generate a significant amount of cash. However, the company earned 8.1 billion from its operations for a cash flow margin of 11.7%. So now when we look at the price forecast, bearing in mind the current price is €41.96, 25 analysts offering a 12-month price target for BASF SE have a median target of €53, with a high estimate of 67 and a low estimate of €40. The median estimate represents a 26.3% increase from the last price target of €41.96. Grandad, I found out some interesting news on BASF SE, which has affected the current share price, if you'd like to hear it. So the first thing is divestment of food and health performance ingredients unit. So BASF sold its food and health performance ingredients business to Lois Dairyfus company, aligning with its strategy to streamline operations. And the second thing is advancements in plastic recycling. So BASF, in collaboration with partners, is working to optimize mechanical recycling of plastics, enhancing its sustainability profile. Next is the expansion of ammonium chloride production. BASF expanded production at its plant, indicating growth in chemical production capabilities. We also have some interesting future investments and future outlooks from the company as well. So they're constructing a large-scale integrated chemical complex in China with a total investment of up to 10 billion. The site aims to serve the growing Chinese market, particularly in sectors like the automotive and electronics industries. The first plant commenced operations in 2022 with full completion expected by 2030. Now, as we learned from the previous share, Grandad, okay, which had an extraordinary high payout ratio and a high PE ratio as a result of poor earnings, I'd say that it could probably be the reason for those high financials, is that these one-time investments in a site in China. We also have battery materials and recycling. So BASF is expanding its production capacities for battery materials, including facilities in Germany and Finland to support electric vehicle industry. And then we have battery recycling as well. So the company is investing in battery recycling technologies to recover valuable materials, contributing to a circular economy in the battery value chain. Grandad, you're awfully quiet over there.
Okay, I'll tell you.
You're worrying me.
I'll tell you. Well, no. I'll tell you now. Right. You left out Roundup.
Okay.
And I go back to, I think I told you about this share at some stage, or maybe I didn't. But my uncle died, and I got shares by way of a legacy in Ferranti, which was made ammunition for armies and so on and so forth. And there was a sanction done by the Americans, okay, whereby you couldn't, I think it was, sell arms to Iraq, okay. The Americans had put a sanction on it. So anyway, Ferranti was a fine old, venerable old ammunitions company in the UK, and decided to buy this company in America because they looked at the figures and they could see this was a company making a lot of money, okay? So they bought the company. And after they bought the company, they went over to visit management. And they said to the management, "What's driving your sales?" And the management got up and they closed the door and they sat down and said, "Now, we're going to tell you something very quietly here. You're not to tell this to anybody. But wink, 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 wink. We do a lot of sales to Iraq." Okay. Now, we can't tell you anything about it because it's in breach of sanctions. And, we have to keep this quiet. But there's a lot of money to be made in it. So Ferranti bought the company. And, of course, it transpired that they couldn't sell any ammunition to Iraq. Okay? And the numbers were all dreamt up by the management of the American company. And Ferranti went to the wall and I said, "Bye-bye, Uncle Jack. It was a lovely, lovely share present that you gave me, but unfortunately, it's worth zero." Okay? Now, BASF, very sophisticated, biggest chemical company in the world, very sophisticated company, it decided to diversify, as one would. So bought this company in the US. Ring, 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 echo, 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 okay? And it was in agricultural fertilizers. Perfect for chemicals, okay? BASF were thrilled. And their main product was a product which my own wife used in the garden. And everybody in Ireland used in the garden. And everybody in the world used in the garden. And it was a fertilizer called Roundup. It went in, you put it in the garden, and the next thing was all the weeds were gone. Perfect. It was the answer to everybody. Okay? So anyway, when people started to die that used Roundup, okay, the court cases started, right? About 10 years ago. And they're still going on. There's still billions being paid out by BASF, okay,
Jesus.
on Roundup. But Roundup has been taken off the shelves now 10 years, right? So that's going to run out at some stage. But it has cost them an arm and a leg.
I actually think I remember hearing about that in the news.
Yeah, Roundup it was called, right? Everyone was using it.
And just for the record as well, it thankfully did not have any health implications for my granny or your wife.
Correct.
Yeah.
So anyhow, companies get it wrong. And BASF got it wrong, no question about that, okay? And of course, I bought it when there was a load of court cases brought in America, and BASF agreed something like, say, 10 billion payout and say another 3 billion for anybody else that might come along. So they charged the accounts 13 billion and the share price went down. Yippee, I'll go in. Now that's over. So I went in. What you don't realize is in America, there's more lawyers, okay, than priests in America, okay? And there's court cases still coming in the door, okay?
Jesus.
Around up, okay? So my share price is down about 30%, okay?
Oh.
I only put the $5,000 in, but it's down about 30%. I can't sell it because I'm getting 8% of a dividend yield on it. In fact, probably 6% of a dividend yield. But the point I'm making is that that's the first thing. The second thing is that's the bad side of it. The analysts, on the other hand, again, 60% of the analysts saying buy. And they're saying there will be a drop in the dividend of 25%. That means it goes from 8 down to 6. Well, 6 is a very acceptable dividend. Okay? So I'm hanging on in. So to me, it's not a buy, it's a hold. Okay? Until this thing sorts itself out one way or the other. The other problem they have is that China was the single biggest driver of exports in Germany. And China is faltering. So it's going to be very difficult for BASF to keep going the way they're going. And they're selling things now to pay for the dividends, in my view, and to pay for their investments. Okay? So they're tricky. they're a hold in my view because I'm
Yeah.
getting the big dividend. Even if I only get 6% or 5%, whatever, still it's a reasonable dividend, right? And why would I realize it? There's a chance that I come back again. They're a huge company. So you'd imagine somebody someday will get it right, you know? It's a bit like Volkswagen, in my view. Someday they'll get it right. But they're
Well,
by no means, as in my view, as good a buy as Legal and General.
okay. I was reading an article just before we started this podcast, which was related to BASF SE, okay, which was that at the minute, there's a pending election going on in Germany, and there's a lot of economic uncertainty in relation to the manufacturing industries because there's a lot of threat about job cuts
Their exports are gone.
and their exports and increased competition from China as well. So I don't know if this would be a good one. And you know what, Grandad, the more I think about it, right, I just don't see how an economy like the European Union could actually compete with someone like China, where there's way less labor laws and labor rights, and they can pay the workers next to nothing and get away with it. How could you compete with that in 30 years?
But don't forget, there's 90 million people living in Germany. Okay, so it's a big market in its own right, and then they're part of the European Union, which is over 400 million people living in it.
Yeah, but that's nearly a threat for them, or a weakness for them.
Why?
Because then they can't compete with the labor costs and stuff and production costs in China.
No, but they've already put tariffs on Chinese cars coming into the EU, right? So what I'm basically saying to you is, right, will the Germans get it right? Well, they're not going to get it right in 6 months. But there is an election coming up in February, and the socialist government that are in would be kicked out, and the Christian Democrats would come back in again. And they have a problem. You see, when they were very wealthy, they brought in this rule that the government could only borrow so much each year. Okay, and that's built in. Now, the Christian Democrats are saying they're going to ease that because the only way they can get out of this is to spend and invest and grow their economy wherever they can grow it. And the debt service break, is what they call it, right, is stopping them doing that. But that looks as if it's going to change in the next month or two. This is not a share, BASF, that this time next year will be growing 20% higher, will be running 20% higher than it is today. But in 3 years' time, it might be 20% higher. And in the meantime, if I can get a decent dividend out of it, I'll hang on in. But the Germans have got to learn that the easy life they had of, selling abroad is going to be much more difficult in the future. The world is becoming more protectionist, and therefore they'll have to do more business in Germany and more business in Europe.
Which could be good for the price of Volkswagens here.
Absolutely. And like the Germans, like they had the biggest army in the world virtually in the Second World War. I mean, they have the ability to manage things. And the question is, will they put the politicians in to allow that to happen? And I think they're going to do that in February. Now, whether the guys that are coming in are able to do it, we don't know. But changes are coming, and I'm willing to give them a shot at it. I've only 2,500 invested in Volkswagen. And of course, at this stage, I'm down something like 30% of my 5,000 in. So yeah. I've 3,500 invested in BASF. So
yeah, the Volkswagen one wasn't a great recommendation for me 3 or 4 months ago, was it? I told you to get in at €125, and now they're comfortably trading at €96. You know what I mean? So, my apologies, Grandad.
No, but investing is fun, and it wouldn't be fun if it was always winning. It's fun when you're down. It's fun when you're up, and it's fun when you're down and you go up, and it's fun when you go up and go down. So long as you treat it like that and never put too much money into anything, overall, I believe you'll make money.
Okay. And on that note, Grandad, I think we'll end it there, okay? Because we've run over the usual time.
Okay.
But really, really interesting stuff on this podcast. I actually learned a lot. Hopefully the listeners at home learned a lot. as well. So I'll sign off by saying, if you haven't already gotten yourself a copy of Grandad's new book, Successful Investing, How to Make Money in the Stock Market, like Grandad will, be sure and go and grab yourself a copy in the link down below.
I wouldn't say grab yourself a copy. I'd say round up a copy.
Round up a copy. Or invest in a copy. And make sure you follow us on Instagram and TikTok. I'm actually just processing everything that is that we've discussed about in this. I'm going to be thinking about this now for the rest of the day. Make sure you go and follow us on Instagram and TikTok at theinvestmenthound.com. And if you have any questions, shoot us over an email on paddy@theinvestmenthound.com. Thank you very much for listening. We'll see you next week, where it's my turn to pick 2 shares. And I think, they'll be the last 2?
Yeah, that give us the 20. And that means we'll have 100 grand invested, and then we start to manage that.
Metaphorically.
And we'll have fun with that as well.
Yeah, I'm really looking forward to managing it, because there's been a lot of change since we began this series.
Absolutely.
Some for the good and some for the bad. So,
Yes.
Do you have any last words, Grandad?
No. Rock on. Rock on.
Rock on. Yeah.